Most investors have heard phrases like, asset allocation is the most important decision you'll make. And academically, that's largely true. But over time, I've found that many investors, and frankly, many professionals, draw the wrong conclusions from that idea. They assume that if the allocation is right, the portfolio must be right. Today, I want to unpack why that assumption works early on and why it quietly breaks down as income, assets, and complexity increase. This isn't about chasing better returns. It's about understanding the difference between owning the right mix and having a portfolio that's actually designed. Portfolio design is the intentional coordination of investments, accounts, taxes, liquidity, and behavior towards a specific outcome. Two investors can hold the same allocation, say 70% equities and 30% fixed income, and experience very different results. Why? Because design considers account structure, taxable, tax deferred, tax free, tax efficiency and after tax returns, liquidity and withdrawal timing, rebalancing rules, behavioral risk, not just theoretical risk. Allocation is a component, design is the system. One of the clearest dividing lines between allocation and design is taxes. Pre tax returns are hypothetical. After tax returns are what actually fund life. As income rises, investors face higher marginal rates, capital gains exposure, net investment income tax, state and local taxes, timing decisions that can't be undone. Ignoring taxes doesn't make a portfolio simpler, it just makes its performance harder to clearly see. Design forces the question, where does this return land and what's left over after taxes? Asset location refers to which investments live in which accounts. For example, tax inefficient assets may belong in tax deferred accounts. Tax efficient assets may be better suited for taxable accounts. Growth oriented assets often benefit most from tax free environments. Most portfolios don't make these decisions deliberately. Accounts are opened over time. Assets are added incrementally. The result isn't poor allocation, it's uncoordinated design. Traditional allocation models assume liquidity that often doesn't exist. Portfolio design accounts for required withdrawals, irregular income, emergency reserves, career or business risk, upcoming capital needs. Without this lens, investors may be forced to sell assets at the wrong time, creating avoidable taxes, stress, and poorer decisions. Design doesn't eliminate uncertainty, it reduces forced decisions. Risk questionnaires measure theoretical risk. Portfolio design addresses experienced risk. Experienced risk includes how drawdowns actually feel, concentration exposure, tax ramifications to make changes, illiquidity or pain in creating cash, uncertainty about outcomes. Behavioral research consistently shows that investor behavior, not markets, is one of the largest drags on returns. Design isn't about removing volatility, it's about reducing the likelihood of decisions that permanently impair outcomes. Asset allocation alone may be sufficient for when income is relatively low, accounts are limited, tax exposure is minimal, cash flow is simple. Portfolio design becomes critical when income rises, accounts multiply, taxes matter materially, trade offs become permanent. For many professionals, this shift happens gradually and is often unnoticed. Here's a quick way to evaluate your own situation. Can you explain why each asset is in a specific account? Whether performance is viewed on an after tax basis? How investments align with actual cash flow needs? Whether rebalancing is intentional or reactive? Whether the portfolio reduces emotional decision making? If several of those answers are unclear, allocation may exist without true design. Asset allocation is absolutely necessary, but is it sufficient? Portfolio design turns that allocation into a coordinated system that reflects taxes, behavior, liquidity, and real world constraints. For higher income and higher asset households, that distinction is often the difference between acceptable outcomes and optimized